So, so we're going to have a few presentations. We'll have a little bit of time after each presenter for Q&A, and then we'll have some more time available at the end as well. So again, this is our Lunch and Learn. It's supported by Tompkins Trust Company, and we're going to cover business loan insights today. The first presenter is Wesley Slyke, who is with Pursuit. Wesley is the Vice President and Senior Business Development Officer with Pursuit. And Pursuit is a CDFI, which is a community development type institution. Wesley's going to explain a little bit more what that means. Essentially, it's a lending institution that has some community development and community impact goals as part of its mission. And so we're excited that we can help share a little bit more about Pursuit and what they do and what CDFIs do as one of the types of economic development lending partners. So Wesley, I'm going to turn it over to you and have you get started on your presentation.
Thanks, Jennifer. Hey, thanks for coming today, everybody. Let's see here. This will be the most difficult part of the presentation when I share my screen. Let's see if this goes here. All right, there we go. Everybody see that? Good. All right.
Yes.
Yeah. Well, again, thanks for putting this together, Jennifer. We appreciate it. Excited to talk with everybody today about this because you know, I've been in the, the banking and financing industry for 15 years. And like everybody, I've been on the side of the table as well, where I'm trying to get loans and not quite understanding why sometimes I'm not able to get approved, but having been in the industry for a while, it's, myself and, the under lenders on the call, we've gained some insight and really excited to kind of, just kind of share it with you. And then, also just so you can get, an overall point of view of, kind of where to go when you need certain guidance, maybe where to start and, what institutions might be, the best fit for you, depending on where you are in your business stage. So let's just start off, a little bit about, Pursuit ourselves. Community focused lender. We have 65 plus years of history, and we have over 15 different loan products. People know us mostly for our SBA loans that we offer, the 504 product and the 7A product. And we are also, in addition to being a CDFI, we're also a CDC, a certified development company. And you need to be a certified development company in order to offer the 504 loan. But today we're really going to focus on the CDFI. And again, a community development financial institution, just a little bit about what they are here. We're mission-based lenders certified by the U.S. Treasury. And typically, almost always they're a nonprofit. Financing is available, for startups, existing businesses, for working capital, equipment, leasehold improvements. Basically, CDFIs have a wide range that they're able to cover and help people with. Actually, let me go back another slide here for a minute. Something that makes our CDFI a little bit different at Pursuit, though, is typically, a community development financial institution, like they're mission-based lenders. And most CDFI's mission is to help a certain geographic area. And not only do they help with business loans, but they get into all sorts of different areas of the community. They may have programs, helping, veterans. Again, they may have programs where they'll help with childcare. They'll have programs where, on the personal side, if there's certain, neighborhoods in the community where there's houses that are abandoned or undeveloped, they might have programs to help people get in there and, purchase those houses and, fix them up. And again, they'll do that because it's for the good of the community. And that's what a CDFI does, community development. Again, and all CDFIs have their own mission, but most of them focus on a specific geographic area. And that's what makes Pursuit a little bit different. We have a very narrow focus on what we like are aiming to help people with. Our mission is basically twofold. We want to be able to get business owners money as quickly as possible. And we want to be able to get them that money when they're not able to qualify with a traditional lending institution like a credit union or a bank. We came up with this mission for our CDFI because, I'll let my other lending partners speak as well to this, but typically when somebody, isn't able to get approved for a business loan at, a bank or a credit union, unfortunately, there's not a lot of second steps sometimes. Like the next step after that, a lot of the time is unfortunately, like predatory online lending, where the interest rates are going to be extremely high and there's going to be fees charged and just really unreasonable terms, overall. And our CDFI's goal is kind of to be that spot in between. So if somebody can't get a loan at a traditional lending institution, they can come to us instead of going to, again, one of those predatory online lenders. Another one of our goals is, not when somebody comes to us, we're the only, type of business that really likes to see people leave. Our goal overall is, once we're able to get that, if we can get the person approved for that loan, is, we want to help their business grow, become more successful. So the next time they need a loan, they can just go to a traditional institution and able to get funding that way. And to do that, we have a couple different ways we do that. And I can, get into those in a few minutes. But the next slide I want to show here, and again, like I've sent this slide deck to Jennifer. So if anybody wants this after the presentation, feel free to ask for it because there is some useful information in it. And this is one of my favorite slides right here. This is, the capital continuum. And it basically shows, where people are at different points in their business life cycle and where they can go, to get money. Again, first rung of the ladders is, kind of what you would expect it to be. Bootstrapping, maybe a home equity line of credit, angels or equity. Next step up from that, gifts or loans. And then the next step up is, alternative lending institutions where, a CDFI can kind of fall into that as well. And if you look over to the right-hand side, it kind of gives you, the pluses and minuses, of both, types of institutions. So again, this is a good chart, and if people have questions on it, we can come back to it. I just want to make sure I get through my slides right now and can answer any questions, and also so we have a group discussion at the end. So, when should I work with a CDFI? Again, you can refer to the previous slide, the capital continuing here. But again, the biggest thing is, it's a mission. CDFIs are mission-based lenders, and, they're more lenient in their underwriting terms than a traditional, financing institution. So, for instance, this is kind of like an overall, generalization of, some of the loans that we offer. And, one of the things that we do as well, and again, like all CDFIs are good, and all CDFIs, help the community and businesses. But one of the things we're able to do is, just to go back to here again, because community mission-based lenders, and again, most CDFIs will focus on helping, a specific geographic area. So what's good about that is, if there's a business who, is, again, maybe they have some credit issues, maybe they have collateral issues and things like that, a CDFI will consider these loans when a bank or a credit union cannot, because the mission of it is to help the community. And again, if there's a business where just like it's a really great idea, and not only is it a good idea, but maybe it's going to go in and occupy a currently abandoned building, or it's going to do something to help rejuvenate a commercial corridor. You know, a CDFI will consider that loan, again, because it's not just helping that person and that person's business, it's helping the overall community. However, this process a lot of the times takes a long time, because again, if it's, you know, if the person isn't, you know, can't be traditionally qualified for a traditional loan with a bank or a credit union, there's going to be some hurdles to get through. And, you know, that CDFI is going to wind up really working with that person for a long period of time, probably on their business plan, and just putting all the details in place so, you know, that they can work towards that approval. What, you know, Pursuit does, what makes us a little different is, you know, we don't do startups, for instance. We do 2 or more years of business, and this is kind of our high level eligibility here. And again, I'll let my partners at Tompkins and Visions, you know, talk to this a little bit, you know, as far as what they're looking for. But this criteria is, you know, a lot more lenient than a traditional lending institution. However, what's good about this too is we have this exact criteria. So one of the things that predatory lenders have gotten right is that they can typically, you know, fund a loan very quickly. It's only a quick approval process, and they can fund the loan very quickly. So that's part of the narrow, you know, aspect, you know, our CDFI is trying to fill as well. We have this set criteria here. So if somebody meets all of these criteria, and again, like the caveat to this is probably half of the loans I do are exception based, and they don't meet all this criteria. But if a business does meet all this criteria, we can typically get a decision in 2 days and funding for the loan within a week. So it's a really, you know, so not only are we able to, you know, fund loans that, you know, a traditional institution can't, but we can fund them as quickly a lot of the time as a predatory online lender. So this is good for people when they're in a situation where, you know, if you own a plow company, for instance, and we're getting this big storm, you know, coming up, if your truck breaks down, you know, you're out of business until you can get that truck going so you can plow it, So if you go to a traditional bank and they can't, you know, fund you, more likely than not, that person's going to turn to any source they can, even if it's a predatory lender, because they're out of business till they get that fixed. Again, we're able to meet, you know, that spot in between predatory lending and, you know, traditional bank lending, because we can get things approved quickly. Again, 2 or more years in business, 2 or more employees. The big one here is a break even or positive cash flow. So as long as you're breaking even, you know, on, you know, with the loan proceeds and payback terms calculated in, it's a loan we're able to do. And the kind of loans we offer are all sorts of different loans. At any given time, we have 15 to 20 different loans. But again, they'll depend on, we have specific products for women and minority-owned business. We have specific products for veterans. But we have specific products based on regions. Like we have a specific loan for women and minority-owned businesses in the southern tier. So I normally, and based on all those different, you know, loans that we have, the interest rates on those, they fluctuate a little. They're typically between, but they are all between 3 and 11.99%. So it really depends on what the interest rate is. The interest rate depends on, you know, everyone's own demographics, but the application process is easy. You know, it's an online application, takes normally about, you know, half hour or so. You can upload your documents to it, and it's done pretty quickly. And again, the document requirements are pretty easy as well. We only need 2 years of tax returns, you know, business and personal, an ID, and a voided check. One of the other things I want to cover here is our business advisory services. So again, I mentioned our goal is to get people back to the people who referred them to us as quickly as possible. So one of the ways we do that is through our business advisory service program. Everybody who gets a loan with us has access to a grant program we have. And this grant program can be used for any sort of scope of work that's going to help that business improve. You know, one of the things I did a ton, you know, during the pandemic was, you know, websites. Because if somebody, you know, during the pandemic, we couldn't come into contact with people. And if we're, you know, if you didn't have a website, particularly a website with e-commerce capabilities, your business was going to have a tough time. So when people came to me for a loan, in addition to that, through this business advisory services program, again, depending on other criteria, we can typically spend between $2,000 and $5,000 a person on some sort of program for them, whether it be a website or whether it be, you know, financial management. And you know, for instance, financial management, what I've done for people in the past with that is, you know, I paid for the QuickBooks program, and I paid to put one of their people through QuickBooks training. The thought is it's going to help that business be better and more successful. So again, next time they need a loan, they can go just right to a traditional institution. This right here is like, how do I find a CDFI? This is a CDFI locator. So again, I work very closely with all other CDFIs and all traditional lenders in general. You know, Tompkins envisions on this call being a couple of them, because my focus is very narrow, and I really can't be all things to all people. But you know, you guys, for instance, you have another CDFI in town with alternatives, and they're able to offer a lot of things on the consumer side as well. So, but again, you can use this locator, and it will you know, show you some other CDFIs in the region. This is my contact information here. So again, if anybody has any, you know, questions, you know, once the call is over, you know, you can feel free to email me, or again, just give me a call. But if anybody have any you know, initial, you know, questions, or you know, because if you want to wait till the end, we can do that too, because I'm sure after, you know, both Justin and Jim go, you know, you'll have some questions as well.
Any questions for Wesley before we move on to the next presenter? Nothing right now? Okay. Great. Well, thanks for that, Wesley. Appreciate it. Our next presenter is Justin Earl. He is the commercial banking relationship manager with Tompkins Trust Company. So Justin, I'm going to turn it over to you.
All right. Thanks, Jennifer and Wesley. Good afternoon, everybody. Get my screen pulled up here. Okay, can everyone see that okay? Looks good. Okay. All right. So yeah, thank you. And as Jennifer mentioned, so Justin Earl with Tompkins Trust Company. I'm now in our commercial lending department, but prior to this, I was in our small business lending team for 4 years. So when Wes reached out, thought it'd be a good opportunity just to kind of meet with some folks and just chat, and you know, kind of focus on what I call how to become bankable. Right. So Wes was mentioning before, you know, conventional bank financing kind of can be a little bit daunting, right? Like where to start, what do, you know, banks traditionally look for, and just how to be best prepared. So kind of running down through this list, the 5 C's of credit that they're kind of been coined over the years. So character is big. In other words, you know, your kind of your experience and just who you are as a person, right? You know, kind of investing in the person, especially if it's a newer business. You know, does this person have what it takes to make a real go of this and make it a success? So, you know, character, integrity is definitely something that we look for. And even at the higher levels, you know, someone who's been in business for 10 plus years, if you don't have that character, you know, that we feel we can stand behind, and it's one of the big flags that can kind of pop up. So character is big. I'm sure you've all heard, you know, cash is king. In this case, cash flow is also king. So we look at, you know, a business's ability to repay the loan, repay the debt along with any other debts that might be in the picture, both business and personal. So from a cash flow analysis standpoint, credit score does matter. We don't have, at least at Tompkins, like a hard set line as to like what score, we need to be above and can't be below type of thing. Because I'm a big believer in, behind every credit score, there's a story, right? If there's been some bumps along the road, let's just kind of get behind the details of that and what happened. And if it's something that's explainable and makes sense, we could probably still make a case to move forward. Collateral is big, whether it is, equipment, accounts receivable, real estate. We'll get into that a little bit more here in a second. Capital injection, kind of what's also known as like skin in the game, like how much of your own cash, own equity are you investing in your business, in this project. Just makes you a lot less likely to walk away from it, right? If you've got a significant level of investment, you're going to want to see that through and see it to a success just as much as we are. And then owner operator experience, I mentioned it a second ago, but just how well versed are you in the field that you're going into and pursuing with your business. For example, if you're looking to open up your own bar restaurant, right? What kind of experience do you have in the restaurant field, front of house, back of house? Have you been working for someone for a lot of years and now want to branch out and do it on your own? Or are you kind of coming in a little cold to it and kind of new is something that we definitely look at. All right, so types of loans, kind of a high level overview, not so much like diving in depth into like products, but just like loan types. And hopefully it'll be helpful for the folks on the call to kind of get a better feel for what means what, because sometimes bank jargon can be a little intimidating. So you've got your line of credit, which I'm sure everyone has, heard of, at least not maybe on the consumer side with like a home equity line. Your term loan, also known as an installment loan. Commercial real estate mortgage, commercial equity line of credit, very similar to a HELOC. I can touch on that more here in a second. And then also overdraft protection, which is tied to a business checking account. So when is a line of credit typically used for a business? A lot of the times, at least what I used to hear in the past, right, is when someone was coming looking for financing, 9 times out of 10, it was, hey, I need a line of credit. Maybe let's kind of talk about what you're looking to use the funds for. So a line of credit is really driven around short-term working capital needs. So maybe it's funding a gap in your accounts receivable. If one of your customers pays you every 30, 35 or 45 days and you need some cash to kind of shore up, a gap in funding until you receive that payment. So in other words, you would pull from the line of credit, and then as soon as you got that receivable, you pay the line of credit back down. So so you can kind of keep doing business day to day. That's really common. Inventory financing is also common. Payroll cost and any expenses related to your employees, that type of thing. Basically funds that you're going to be able to revolve or pay back within a 12-month period, because more often than not, that line of credit is going to be structured as interest only payments monthly. So in other words, the principal balance isn't going to go down unless you make those conscious extra principal payments or pay the balance down once that receivable comes in, like we talked about. We talked about that, cyclical and revolving in nature. So the way I kind of always think about it, it's just like a big credit card, right? It's kind of like a roller coaster. You draw on it, you pay it down, draw on it, pay it down. It's there to tap and use as you need. Depending on if your business is seasonal or where you're at in your cash flow cycles, but it's definitely kind of an in and out type of facility. A term loan or an installment loan, think more along the lines of like long-term permanent financing needs, whether it's working capital, maybe a piece of equipment. So going back to Wes's point earlier, his example of a plowing company, say you needed to buy a new plow truck, that would be a term loan or installment loan, generally structured like the same useful life as the equipment, so maybe it's 5, 7 or 10 years 10 years is usually the longest you'll see on a term loan, probably more traditionally 5 to 7 years. And just level principal and interest payments. Again, so kind of, or permanent working capital to the business if it's more permanent, long-term inventory purchases, that type of thing. Anything that's really going to be, longer than like a 12, 24 month, repayment period is kind of your term loan. Think like just your vehicle loan, right? If you have a car loan, that's a term loan. Very comparable on the commercial business side. Real estate mortgage. This one's probably pretty straightforward to everybody. Involves a building, right? Real estate. Maybe you're purchasing a location for your business, or you're leasing your current space, and now you want to buy that building in order to start, investing some equity. You could, also leverage the property to pull some equity out, depending on, how leveraged the property is. Maybe you want to expand your business, do an addition. Or also from like a landlord real estate investor side, if you're looking to, purchase maybe student housing or regular residential, rental units, that would also be fall under the scope of a commercial mortgage. So application process, kind of similar to what Wes was touching on in terms of like a complete loan package would be, your application with all the pertinent underwriting materials. So, tax returns, personal financial statement, we would obtain a credit report. Maybe we need year-to-date numbers like a profit and loss or a balance sheet, accounts receivable, aging statement, just any kind of, business financials that maybe you would pull off of QuickBooks or whatever software you might be using for your business. And then once you got all that submitted to your loan officer, who would then work with their underwriting team, ultimately the numbers would get crunched. Any questions that might pop up, for clarity, maybe there's some ebbs and flows and cash flow we need to get to the bottom of, and then essentially arriving at a decision, right? Either approving what was requested, maybe we need to counter offer for one reason or another, or maybe, there's just, we just can't get comfortable with the request at this time and we do need to pass. But that would be when, maybe I turn back and reach out to Wes to see if, if there'd be something that, he in pursuit could do from a CDFI perspective. And then if approved or counteroffer accepted, obviously the closing and the funding. So if you are a startup, so brand new business, this can kind of be, the most risky. I would tell you at Tompkins, we often lean on the SBA to kind of help structure a startup loan if we are going to move forward with it. So kind of thought it would just be a good idea to kind of cover some of the high level stuff that we look at and that you'd need to kind of approach financing if you're brand new to opening your own business. So we'll always look for a business plan. Usually within that business plan, contains financial projections, and you'll see the word there, reasonable, on the screen, right? Very easy to put pie in the sky projections on paper and say, hey, we're going to make $1 million in the first year. Banks will look at, okay, given our knowledge of the market, the industry, what do we really think is reasonable? And are these projections kind of within that realm, or maybe they're a little too conservative, maybe they're a little too aggressive, and kind of have that discussion. Probably will be a little bit more of like an in-depth interview process conversation, with your loan officer, just because, there's more risk to it, right? So more risk, and banks are going to ask some more questions to kind of really get to the bottom of if we think that this thing's got the legs to make it and be a viable business, looking forward 3-5 years in the future and so on. I would really, recommend, if you are a startup or have a business idea that you want to kind of, vet out, utilize lean on your local partners. So think of places like the Small Business Development Center, your local BDC. Those folks are just awesome at, talking through an idea, helping you put together a business plan, and really, asking some tough questions around, okay, what if this happens? What if this happens? How are you gonna pivot? How are you gonna face maybe if this adversity comes up? They're definitely good at making you really think things through, and they kind of help you get as best prepared as you can to then approach, maybe Wes, myself, or Jim, or any other bank, credit union in the area to try for financing. Then the Small Business Administration, which I mentioned before, the SBA. Definitely, from their Express program, that's a big one you might hear with startup financing, depending on the dollar amount. So just some business plan basics. I'm by no means an expert in putting together business plans. I've reviewed several over the years, and these are just kind of the boilerplate items that are seen in most. Just your summary plan, kind of your executive summary, who's the owner operator, and just kind of what, a little bit of background around him or her. Have you done your market analysis, competition, description on the company, what you do, how you plan to do it. Again, management and organization, do you have any people who are going to be coming in right away as partners with you, and maybe managing the day-to-day. Marketing and sales analysis. Again, what product, service line are you offering? What you're actually asking for financing, and then again, those financial projections that I mentioned a slide or two ago. I thought it'd be good to just touch on who are some good folks to kind of keep in your corner from a business partner's perspective. Bankers, right? We're free advice, right? We're not attorneys. We don't have billable hours, so we're great people to ask questions to, bounce ideas off of. Hey, do you think this would work, or what about this, or what are you seeing in the market? Can always lean on, maybe it's your loan officer, maybe it's your local branch manager. A lot of those folks typically have, a small business lending background as well. Your accountant, that's a big one. I would say accountant and bookkeeper kind of in the same light, maybe more so your accountant. It's a great person to stay close with, especially as your business takes off and gets off the ground. So they know where you're at with things, what are your plans for the next year, how do they need to help you maybe limit some tax liability, also show cash flow on a tax return, because ultimately banks are going to look back to that tax return for cash flow. That's kind of, for lack of a better term, the Bible from the underwriting perspective, right? Attorney, they're probably going to cost you, but from legal advice standpoint, right, having a good counsel in your corner is important. You want to make sure you're properly covered from an insurance perspective, whether that be, from a property standpoint, just general liability is huge. Protecting yourself, your business, and yourself personally if any lawsuits were to arise. And then just any trusted, experienced mentors. If there's people in your network, in your circle that you've worked with prior, or just people who have a lot of experience that kind of can take you under their wing and kind of show you the ropes. Those definitely people that are great to stay close to. So I will pause there, see if there's any questions. If you want to, feel free to type them into the chat, or just unmute yourself and ask away. Happy to answer any questions.
Does anyone have any questions for Justin before we move on? Okay, lots of good information being shared today. Thanks, Justin. I'm sure folks might have more questions or engage in a dialogue at the end. So our last presenter today is Jim Lavo, who is the Senior Member Business Lending Loan Officer. Please feel free to correct my my effort to get your title correct with Visions Railroad Credit Union. So Jim.
Well, thank you for having me, and thank you everyone for attending. I've got a slide. I'm going to share it in a minute, but I probably will go through that fairly quickly because Justin and Wesley did a great job, and some of it's going to be redundant. And I'm going to focus more on two things. One, I'm going to focus on the process where we get together. We go through the process, what happens after we meet, and then where it ends up. Second thing is also probably going to talk more towards maybe the not mature businesses, but maybe startups, or maybe a mature business that's maybe been struggling and designing themselves. And so it's going to be more geared towards that. And now I'm going to try to share my slide. I'm not very good with computers or technology, so hopefully this works. Do you guys see the business lending in my name, hopefully? Is it? Okay.
Looks
Okay,
good.
so, a little bit, real quick background on myself. I'm probably the senior member here. I've been in banking for quite a while. I've been with M&T. I've been with short time at Chemung. Now I'm with Vision Center Credit Union. We do a lot of commercial real estate. We do some C&I business. I've been here for 6 years, and I've done everything from $100,000 equipment loan to a $20 million student housing complex. So I've kind of done the gamut of everything. With that, Visions and M&T and Chemung. So what I want to do is go to the slide again. I might be going through this fairly quickly, and if there's any questions, feel free to stop me or wait to the end. The first thing is, what is a small business loan? Every bank looks at it differently. At M&T, it was basically, it wasn't the size of the loan request. It was more of the size of the business. They consider small business 10 million and under. And the request, how complex it was, it may determine it as well. If it's a small business at 5 million, but the credit facility was pretty complex, it may be going to the next level, which is the mid-market groups. What are the types of business loans? Basically, Justin went through a good job of them, so I'm not going to address that. He did a real good job. The one thing I want to caution everyone with is, and Justin said something that is very relevant. Everyone comes in thinking they need a line of credit to start with. And you got to make sure that what you're applying for matches what the term of the loan is. And lines are short term. And I caution people, because a lot of times those lines of credit become long-term loans because they never get paid down. Typically, lines of credit either have a 30-day cleanup in it, so make sure it's short term. If it doesn't, you really got to manage that line properly, because eventually you're going to need working capital and you're not going to have a line available. At Visions, our larger lines are basically, we call them borrowing basis. We lend against percentages of inventory and receivables to make sure that you never go above the working capital on that you have on your balance sheet. But be very careful with the lines of credit. I always caution people with that. We have term loans as well. We have non-revolving lines, revolving lines, and then you also be looking at letters of credit, which really are more geared towards mature businesses. And there's typically secured with some type of liquid collateral, and it's basically a commitment that the bank is replacing you as a borrower from a third party, and they're saying, hey, we want a letter of credit to know that if you're not able to fulfill some need that you promised to do, the letter of credit will enforce. The letter of credit means the credit union, the trust company, will come in and pay the whatever that line of credit is geared towards. What are loan requirements? I'll get into that when I get to the final part of the presentation. Choose the best product. Again, Justin went through this. He did a real good job. I just always say match the term of the loan to the purpose of the loan. Typically, your equipment loans should not be any longer than the life of the loan of the equipment. The line of credit should be short term in nature. And SBA and is basically the group we go to, like Justin mentioned, that if it doesn't meet all the criteria we need, but it's something we want to move forward with, we partner with SBA. And it's not to say that we go to SBA for loans that obviously we have to want to approve it first. We're not using SBA because we're really looking to, for lack of a better word, make a bad loan good. It's a good loan, but maybe it's a new business or it's lacking collateral. So it's got to make sense to the bank first off. SBA doesn't come in and say, hey, we'll make, just come to us if you can't do a loan. Really, SBA says, if you can't do a loan, because of certain criteria, come see us and maybe we can fill that gap. Credit cards, I tell people typically use that for, that should be for purchases that short-term need, lunch, gas, things like that. What are business loan requirements? Typically, I like to see 3 years of being in business. And when I say 3 years, I like to see 3 years of tax returns. So if you've been in business for 3 years, but you started in June, you only have 2 years of financials. I like to see 3 years of financials, at least to understand the business. So we look at tax returns there. But when I look at financial statements, the other things, the financial statements that I look at really for the business is interim financial statements, because again, you might be in June, your taxes are done for that year. You have 2020 taxes done. You haven't done 2021 yet, so you're going to give me or actually you might have. Let's just say you have 2021 done, but you're in June now, 6 months of your tax returns. So I always collect interim P&Ls and balance sheet if the financials are from the last tax return you got is 3 months, has been 3 months since that year end. When I get interims, I typically like to look at not just the current interims, but I like to get at least last year's interim for the same period so I can compare them, see if there's any trends. If something's happened in the last 2 years, I will ask for 2 years of interims that match. So it all depends on the situation, but I like to get interims that compare to the prior years. Tax returns I went over. Typically like to see 3 years of tax returns. I think Wesley mentioned or Justin mentioned 5 C's of credit, so I'm not going to go over them. Only to say that if you took those 5 C's, and I'm going to get towards when I talk about the loan process, every one of those 5 C's actually fit into the underwriting process. So I don't go in and look at the 5 C's when I'm doing a write-up and saying, how does does it address capacity, collateral, capital, character, and conditions. But my write-up, if I were to, covers all 5 of those, at least those 5 conditions. And again, I won't go over that because Justin did a good job there. Applying for your business loan. This is where I kind of want to walk through. This is where I want to spend time talking about what I look at the initial process for any. If you're out there looking for a loan, how does it start? What do you do, and how is it? What happens after the fact? So I always talk about that initial meeting. If it's a referral to me, says they call up so and so, I reach out to them, or if the borrower reaches out to me directly, it doesn't matter. We have a conversation. We set up an initial meeting. I like if it's an existing business, I like to meet at the place of business. I don't want to meet in my office because it doesn't do me any good. It's hard with startups because maybe you don't own the business yet, or you don't have a facility yet, or the tour. But if there's a location that you're operating out of, I want to see it, and I like to see it the first appointment. And also, I think you as a borrower probably feel comfortable and would like to see the banker out there. It's not always able to happen, but it's important to, I think, both of us if that's possible. In the first meeting, really, I want to get a better understanding of the business. I don't want to dive right into the loan request, but tell me about the business. Learn about the cash flow. What have you experienced last year? How did COVID affect you? If there's more than 1 year, what's the trend been? What's going on with the competition? I like to understand the business in that first meeting. How do you bill? What type of terms do you give? What type of terms do you get on your payables? The borrower has these. It's great if you meet the borrower and they have this information. They're prepared. And to me, that first meeting, if they know we're going to get together, I would hope that they are prepared to have some discussion. Who are the customers? And sometimes that customer is who's the end user. Who's your customer has a customer, and who are they? Right now, it's important because with the economy, what's going on with the economy now, you want to know who's your customers and users, what's going on with them, because that's gonna affect their demand. And then the big thing to me is understanding the individual. What's that individual's background? How long have they been in business? They may have owned the company for 3 years, but they may have been doing it for 20 years. They may be looking to buy a business or start a business, and so they're brand new. But what's your background in that business? It's really important for me to understand that. And then the other thing I look at is, who are your key people? Who are you relying on, and how important are they? And the one thing that helps you understand is, if you got a real important key person, what happens? What's your plan if that person leaves? So that first meeting really is to discuss the background of the business and the owner. If it's a startup, when I meet with you, and you may not have it, or you may have a business plan already, I strongly mentioned, as Justin mentioned, you may not have already talked to like the Small Business Development Center, but really they could do a good job with the business plan. So a lot of times, if you don't have them, I direct you. If you have them, we kind of go over a high level of it. The one thing I always mention with a business plan when I meet with a new business is, I always, all the stuff I mentioned. What is your product? Who are your customers? But one of the things you always get is projections. And I typically like to get at least 3 years, a month projections, because really you're not going to understand your initial needs, how much capital you need to put in. If it's a shortfall, how much you need in working capital. Plus, it shows ebbs and flows. Because if you are getting a line of credit, we really need to understand, well, why do you need a line? Well, it's really really a cash flow statement for 3 months, but a P&L would help. For 3 years, I mean, month to month, it helps us understand your working capital needs and your cash flow. And I always tell people, don't do your 3-year projections, your month to month, whatever you're doing, to get an approved loan. That should be your tool to understand, well, first off, is this a viable business? Second off, what is my true funding needs? How much do I need to borrow? How much is it short term versus long term? Is equipment? What am I looking at? And how much money do I really need to get this project going? The one thing is if you do a business plan, and if the bank works with it, and it really is, there's some weaknesses in it, it'll show up. Believe me, it'll show up. The other thing too is, you really need to understand a new business, their working capital needs. Everyone says, well, I'm going to buy inventory. I want to put on my line of credit for $200,000 to fund my inventory needs, and for the turnover, receivables, and what have you. Some of that short-term needs, you walk in and saying, I need $100,000 in inventory, so I need a $100,000 line of credit, or what have you. Some of that inventory needs is, I always tell people, go back and really understand what your inventory needs are. Some of that's going to be long-term. A $100,000 line of credit to fund $100,000 in inventory, or $200,000 line of credit for 100, really may not make sense, because some of that inventory you're buying is going to be core inventory. It's going to be there. It's never going to go below a certain amount. So you really need to understand what your true working capital needs are, and what portion is long term versus short term. And because you want to build that long term in the monthly payments, because you're not going to pay back in 30, 60 days turnover inventory. It's going to go back into inventory. So that's really important. And the other thing for a small business, or for a startup, understand your working capital needs. Working capital needs is more than just inventory. You're going to have to turn the switches on in the morning to turn the power on. You have to pay those employees. It's going to take you a period to ramp up. So I've had business plans come up for, it's 12 months of even income, projected revenues for 12 months. I'm like, you got to build that up. You're not going to open the door tomorrow and do $100,000 to this month and do $100,000 in 6 months, as well. There's got to be a ramp up period. And again, it's going to help you understand your working capital needs. And a lot of times your money going in is going to cover a good portion of your working capital needs. Understanding your lending option, match up your lending option to you got to really match it up to what you're funding, but also to your cash flow. And that's where you got to consider the payment terms. The businesses fail, I find a lot of times, not just because they're undercapitalized in the beginning. is because they're not addressing their working capital needs initially. And all of a sudden they're plowing, they're chasing payments to keep the doors open. And when some of that proper positioning of working capital could not help them. Okay. Okay, and I guess at this point, what I'd like to talk about is, okay, what happens after after our first meeting, and what I'm going to be doing. I'm going to give you a list after the first meeting when we meet. And this is really high level. This is really making it really simple. It's not just simple, but I'm going to ask you for a list of financials. That we kind of everyone I went over it. I think my partners here went over. My time doesn't my clock doesn't start until you give me all those financials. So we have a discussion today. You don't give me financials for a week. My clock starts ticking next week when we get it. I can start some of it, but it's important that you get information right away that the loan officer is asking for. So I get all the information that you've provided, and and will there be more stuff? Yes, there will be. We'll have more questions. Yes, there will be after I get it. So I get it, do my write-up, I call it a presentation. That take 2 days, 3 days, depending on how long I have, because I'm not just looking at your loan, I'm looking at a bunch of loans. And I'm taking care of, every one of the loan officers are managing a portfolio. So I get your information, I gather it up, I do a write-up, I do a high-level cash flow, because I'm not an analyst. I package it, I put it in the system, and I think based on my experience with other banks, pretty much all the same. It goes in a system for analysts to pick up. Now, those analysts are working on deals, there's other deals already in the process. So depending on the time of the year, that might take a little longer to pick up, or like right now is a little low in my, right for me. So it might get there quicker. So some of the timing of it depends on how busy that the bank is or credit union is. So I submit it into underwriting. It might take 3 to 5 days for someone to get available to pick it up. They'll go through it. They'll take your information. They'll do their own cash flow at a higher level. Look at they'll come up with questions, whether it's based on the background. Maybe I want more information on the company. A lot of it's related to financials. I'll go back again to the borrower. I've always asked my analysts, go back and ask them once. Don't be coming back to me and asking a bunch of questions. And then come back with more. They'll do their best to do that, but it's going to happen. I'm going to come back with some questions, and there may be more from the analyst. I don't know, but we do our best. So once we get all those questions answered, that might take, and they finish the write-up, that might take another 5 to 7 business days. So now we're almost 2 weeks into it. Then what happens with me is my boss looks at it and approves it. Now, with the next step for me, it might be different for the trust company, but I think it's the same thing with MIBDC. It goes to a committee, and what my committee is made up of is 3 senior managers, and it takes 1 person to approve it. So we go in and make a presentation. Now I know at Chemung, and they basically have a committee of board members, and it takes a majority. So they have to they get a majority, or majority senior manager, depending on the level of the credit. At M&T Bank, they have I had a senior credit officer, or our credit underwriter that could approve up to a certain dollar amount. Over that limit, he or she went to another level, and above that level, there's individuals that make the decision. It's not a committee, but in our case, it's a committee. And so I got to bring it there to them that if they approve it, then the next step is my CEO needs to sign off, which usually is the next day. So depending on the process, there is a final step for us as committee. Once the committee approves it, then I typically will either send a term sheet out, document out, depending on complexity, or send an email and give the terms and conditions. So at that point, you got the approval. Everything's fine. Now, the other final thing that could happen is a counter offer, which I've done, and I'm sure we all have done, or the other final, it could be a declination. At that point, you sit down with your loan officer and you find out 2 things. Why was it declined? And hopefully walk through it, and maybe there's information that you didn't provide, that wasn't caught. or more importantly, it might be, what do you need to do to be ready in 6 months or a year or whatever? What is missing? So I guess that's the process I'd be looking at and when I'm submitting a request. So I guess at this point, I'm done with my presentation and just ask, if there's any questions, feel free to ask.
Great. Thank you so much, Jim. Does anyone have any questions for either Jim or any of our other panelists? Your information was so comprehensive that we have no questions. Or we've got some experts already here in the house. Could be both of those things.
Well, I guess I don't have a question, but I guess I just have a little additional comment I want to throw out there, that both Jim and Justin touched on, when they look at those 5 C's of credit, really consider that from a holistic point of view when you're going in to apply for a loan as well. For instance, if you're a restaurant and you need to do a fit up on the building, you got to have some more, some newer chairs and some tables and things like that. Believe it or not, that's a situation where, if you need $30,000 or whatever to do that, that's still going to be an under collateralized loan because, worst case scenario, if something happens to the business, there's not going to be a lot, of value in reselling chairs and things like that again. So when things if you're applying for a loan like that, that's when, they're probably going to use the SBA, or they might potentially, refer you over to me, because a $30,000, basically unsecured loan is going to be tough, to get done at times. Another thing I wanted to point out too was, when Justin said, cash is king, it's just cash is king. If you're going into a loan and your business took a loss that previous year, that's going to be a pretty big obstacle, for any type of lender to get around. I've seen, lots of different times, I've seen, people with great collateral, for instance, where maybe they own the commercial property outright, but they didn't cash flow. The business had lost money for the last 2 years. Got to remember that lenders they focus on getting the loan repaid. As great as that collateral is, they don't want to take the collateral and have to sell it to get the money. So if you're going into it and you're not seeing any cash flow, that's going to be difficult. That's when you really have to lean on places like SBDC and people like that, and also grants that are available out there, particularly now because of COVID. So you wouldn't happen to know anything about grants being offered, would you, Jennifer? Maybe through the local chamber or something like that?
Well, we do have some opportunities here. They're very specific and have considerable educational and eligibility requirements. There are sometimes other opportunities as well. We don't tend to, when we're counseling businesses, to suggest grants as a primary funding source. I do think there's a lot of language out there around grants and who can get grants, and that makes them sound much easier to come by than they really are, right? So while we have on-the-job training grants that are particularly for supporting job training for existing workforce being promoted, or for new workforce, and the Workforce Development Board and the Department of Labor also have some of that funding. And we also have a microenterprise grant program right now to support both startup business establishment and also business expansion. Those funds are going to go pretty quickly, and they're finite, right? So we definitely, especially just starting out, most times people need to look to equity, family, friends, all of those sources that you all talked about, and possibly some economic development based or character based lending options, paired with some of that equity and some cash that has been saved up as well, particularly in the beginning. So yeah, thanks for that opportunity to chat about the resources that we do have, though.
Jennifer, can I just bring up something that Wesley talked about and Justin brought up, the capital. Yeah, the one thing also that it's a balancing act, whether it be a startup or what have you, or investment property. When you put capital in, the bank or credit union is going to want to see capital going in minimum, or to make the plan work. If that capital, that whatever reason that's going in, to take up all the capital you have, cash you have. I'm going to look at it and say, well, look, you really need $40,000 into the project, but you got 45,000. So once you put that 40 in, you got 5,000 remaining. One thing that we don't want to do is take all the cash. If it needs all your cash to make this work on the business side and leaves you nothing for, to support the business during a downturn or any hiccup along the line, we're probably not going to be able to help you. So when we talk about capital, it's not just what is needed for the project you're looking at, the business. You better have some cash available, because it's not a perfect world, and you're not going to, your cash, your payments are going to be based on, hey, I want that payment this month. So you may have to dip in your own pocket. Hopefully you don't, but keep that in mind when you're looking at starting a business. You got to have enough cash to go into it and then keep on the sideline as well.
Yeah, I would just echo Jim's comments. I mean, that's spot on. That personal liquidity piece is huge, and that's regardless of like size of the business, size of the loan. We're going to want to see some type of safety net there, right? Because to Jim's point, you have a down year, you fall on some tough times. The business isn't doing as well as it did last year. Okay, now where are the resources coming from to kind of continue to make those loan payments, keep the business going? And like Jim said, if you sunk your last dime and just getting off the ground and the safety net's totally gone, I mean, that's a huge risk. So yeah, I mean, it sounds like we're asking for a lot as lenders, from, especially when you're looking at a startup business. Okay, hey, here's 20 grand. We're going to say, okay, well, do you also have 20 grand to fall back on if you needed it? So it sounds like a lot, but at the same time, at the end of the day, you don't want to have your back against the wall. God forbid something were to happen that was unexpected. So
those are very important reminders. I'm sure we've all seen our fair share of folks trying to start out undercapitalized, and they've saved up X amount and they think they're ready to go now and going to try to start a business on $5,000 or whatever it may be, without having enough protections for themselves and understanding the amount of personal equity and personal cash investment that really needs to go into it under almost every circumstance. So great information shared today. Thank you so much. As I said at the beginning, we did record this session so that we can make it available to members after the fact. Again, this has been Business Loan Insights, part of our Lunch and Learn series, supported by Tompkins Trust Company with the Tompkins County Chamber of Commerce. So thanks again to all of our panelists, Wesley Slyke of Pursuit, Jim Lavo from Visions, and Justin Earl from Tompkins Trust Company. Have a great day, everyone.
Bye, everyone.
Thank you.
thanks, everybody.